Yes, Naren, good morning. Thank you for joining us. At the outset, wishing you and your family happy Diwali and a wonderful year ahead. So, Naren, we are calling our tagline this year on ET now as Naya Saal, Nayi Shuruaat. So, what is the Naya Saal and Nayi Shuruaat for investors this year?
I think first let me wish all of you and all the viewers of ET Now a very, very happy Diwali. And I think going from here, things, the way I look at the Naya Shuruaat, you are at a situation where there are a set of stocks which seem to be extremely cheap. And there are a narrow set of few stocks which appear to be pretty costly. So it doesn't appear that both of them are in the same country with the same economics, economic growth and other parameters. So I believe the way I look at Naya Shuruaat is the fact that if you invest for the long term in the cheap stocks, I think very rarely you have made losses. So, and I think that is clearly the situation, because actually what is now culminated in a set of costly stocks is not 1 year performance. It is actually, I would say, 12-year performance. For 12 years today, if you compare 2007 Diwali with 2019 Diwali, you'll find that there is a set of stocks which have done badly for 12 years. And many of those sectors, there are no new entrepreneurs coming. There are only old entrepreneurs exiting those businesses. And I believe those are the places where I believe there will have to be a new trend, because one of the lessons of investing is if there are too many entrepreneurs exiting a business, the residual entrepreneurs make a lot of money. And that is the kind of situation we are in at this point of time.
What do you make of this entire promoter pledge issue? For promoters who've taken big risk in infrastructure, in the power sector, in the cement sector, they're feeling the heat, whether it's the Imami Group or the Z Group, and there are a lot of other group companies. Do you think this entire promoter debt issue on their personal balance sheet or holding company balance sheet is going to be a recurring factor which will drag down earnings, spending, and also markets?
See, I think sometimes there are unintended consequences. So if you look at the environment post 2013, you had much lower inflation. When you have much lower inflation, there is one thing about inflation. Inflation is one person's output and another person's input. People forgot that inflation has gone down structurally in most parts of the world, and after 2013 in India as well. So what happens is the returns that you can get on projects or anything like that is also dependent on inflation. People thought that they were in a 2002 to 7 world where if you borrow and you can get borrow at, let's say, 10%, you can get ROE of 14-15% easily. But that is not the trend, and in fact, as I mentioned, in the 12 years you have had many sectors which have delivered ROE much below the cost of debt. So I believe this is a one-time problem, and I think Indian entrepreneurs are smart, so they will find a way out of the problem. If you go back to the 98 to 2002 cycle, you had similar situation where many of the promoters went through a similar kind of problem. They came out, and after that you had that brilliant move in economy from 2002 to 7. I believe we'll have something similar where promoters will gradually work their way out of this problem. And some of them, of course, will not recover, and the balance will recover, and they will know how to handle it. It's important that people have to recognize that we are in a lower inflation environment, particularly in the world, and that lower inflation environment in the world means that you have to prepare yourself for lower nominal rates. Last week we had a meeting in our office where most IFAs, many of the IFAs told us you should get 15% in equity. 15% in equity need not be such a small number any longer if you're going to have much lower inflation. If you had 10% inflation, maybe 15% is an easy return. But if you don't have 10% inflation, 15% is not an easy return, and that is the challenge at this point of time that investors have to realize, promoters have realized, in my opinion. And I believe that everyone has to realize that, and once they realize that, things will become better. That's the way I look at it. But there is a phase where people have, there is a correction phase, that correction phase where people correct their old mistakes. We are in that one of those phases.
Naren, wouldn't you say that given the kind of battering we've seen in some of most of the small and mid-cap stocks when it comes to the broader markets, even a 15% return scenario is looking a little challenging right now?
No, I think basically I don't think 15% comes to you automatically, but I think you have to also look at what you get today, let's say in a fixed deposit or a liquid fund or a savings bank account. And I believe that if I invest in a set of cheap stocks relative to intrinsic value today, I think if you're not wanting to look at the NAV every day, but you're willing to be patiently invested for 5 years, I think you're going to get good returns in patient long-term investment at this point of time. Whether you get 15% per annum or slightly lower returns or even much lower returns, but better than what a risk-free investment can give you, I think there is opportunity. And I don't think 15% per annum is such an easy return to make even from here. I don't think you're going to get that easily. But what are the rental yields on real estate in India? What are the fixed deposit rate? What is liquid fund rate? What is savings bank rate? So I think you have to remember that all the rates in the economy, all the returns in the economy has to be linked to all these things.
But Naren, exactly, and I guess, it's a culmination of all these things that have kept the retail investor really a little bit shaky. If I were to look at the kind of SIP data that we've got from AMFI as well in the last 3 months, that seems to be indicating that, somewhere money is moving out of equities and somewhere you're seeing outflows and a crisis of confidence even with the SIP money. What is the message that you would like to give to the retail investor? Is this the time to actually increase your allocation? And if that be the case, what kind of diversification would you recommend best at this juncture, say for the next 2 to 3 years? Should the largest part or largest allocation be towards equity? And within equity, would it be large caps? Would it be mid caps? Or a mixture of both?
So I think if you look at the way investors have behaved, I've been very, very amazed and very, very happy. Because if you look at it, SIPs have continued, and I think it is very, very important that people continue with their SIPs in the next 3 to 5 years. And I believe that investors have been doing that, and that has been a source of happiness for the mutual fund industry and us, because people have realized that you have to invest in SIPs over the next 3 to 5 years. And I think that is very, very good development. I clearly think many of the small caps and many of the mid caps and most of the large caps are attractively valued at this point of time, that there is a case to increase the quantum of SIPs. So that's why we are doing a campaign called Har Diwali SIP campaign, because I think clearly there is a requirement of higher SIPs at this point of time. And the essence of SIP investing is when the market goes through a sideways motion or a decline, at that point of time you have to have higher investments, and that is what SIPs will effectively provide over the course of the next 3 to 5 years. I clearly think small caps have much better absolute return potential over the long term, over mid caps, over large caps, over mega caps. And in my opinion, as far as credit is concerned, clearly that is an asset class which can deliver very good returns even on lump sum basis at this point of time. And frankly, on a lump sum basis, credit appears to be a great asset class at this point of time, along with short to medium term. Again, higher share of credit. Like, you can't only invest in government securities and expect to make money at this point of time. So I think clearly debt is a great lump sum asset class at this point of time, and equity is a great SIP asset class at this point of time. And I believe that investors have been listening. And I think that is the most interesting development at this point of time. And I hope they continue to realize that SIPs are the best long-term investment asset class. 3 years back, small caps and mid caps, or 2 years back, small and mid caps were very expensive. But I think going forward, SIPs in small and mid cap are attractive simply because these are accumulation times in the market. And I think we are very happy, and that's why we focused all our campaigns on SIPs over the last 1 year.
I mean, both of us know that SIP is the best and perhaps the most effective way to reach your financial goals. But perhaps on the Diwali show, viewers want more than SIP. They want to understand where does Naren feel there is a near-term and a medium-term opportunity. Which businesses, like you identified telecom a year ago, which is the other sector or a business to your mind where we are close to an inflection point, whether it's market share gain, whether it is earnings gain, or whether it is pure margin expansion. That's how you typically hunt. You like to buy beaten down sectors which are at an inflection point of where market share gains would be large. Apart from telecom, which was last Diwali's idea, what is your this Diwali idea?
So I think power and pharmaceuticals are two very interesting sectors at this point of time. Clearly, if you look at it, 12 years, zero return, 12 years, demand must have gone up at least 70-80%. There are fewer power companies today which are active in the power industry compared to 12 years back. Even if you look at disruptions like electric vehicle, they don't say that electricity will become obsolete in the next 10-15 years. So I think clearly power, because if you look at trailing price to earnings and price to book of the sector, which is something which we use as an indicator of how cheap a sector is, it's one of the sectors with a huge number of cheap stocks at this point of time. And I believe that it is not something which is going obsolete in a hurry, despite all the disruptions in so many other sectors. The second is with my cough and cold, clearly I can see that pharma is another very interesting sector. The 4-year returns have been pathetic. And clearly you've had issues which no one could have even factored in 4 years back, the number of FDA problems which has shown up in the industry. We continue to be the drug makers of the world, and I think again here Indian entrepreneurs will improve their quality standards, and clearly I believe that that would be another very, very interesting sector. I think our current focus is that if you exclude 10 stocks from the market and look at the valuations, you actually get a very, very different picture. So when we look at valuations in the aggregate, you're getting actually average valuations, which means markets are neither cheap nor costly. Both on small cap, mid cap and large cap, things seem okay. But if you exclude a few stocks, I think the markets are looking pretty cheap at this point of time, which means that long-term investing in a set of underperformers at this point of time is also going to be very good. This includes many small caps, many mid caps, and I would say 40 out of the 50 nifty stocks. And I think that is another clear trend at this point of time. So I don't think, I think money can be made. One will have to be patient, and I think there are today, unlike 2 years back where most of the small and mid caps were costly, we are at a time where there are many interesting opportunities, and I think the more and more investors invest in mutual funds at this point of time, I think they're going to make good returns in the long run. That's how we look at it. Near term is very difficult to guess, because in the past when we have had such wide divergences of valuations, we have seen a period where the markets actually tend to consolidate. And that can still happen at this point of time. But I think for long-term investors today, there are a set of cheap stocks to invest in. Power pharma dominate my sectoral preference at this point of time. And I would say clearly small and mid caps almost across the board also meet that requirement.
Okay. Talking about some of those preferred pockets then, Naren, if we take a look at the easing rate cycle. And it looks like we're coming now close to the end of it. Let's say even if we factor in another 50 basis points over the next 3 to 6 months, we're nearing the end of it. What then happens to, pockets like banks, utilities, particularly areas of the market where you also have been, very big on? What would then happen to some of these holdings? How do you see things panning out?
I think clearly if you look at dividend yield as a category, you find that there are so many stocks which are attractive today relative to what you get today in liquid funds, for example. And I believe if I look at banks are going to benefit out of easing corporate credit cycle, and that is why it's very important that bankruptcy code delivers many judgments which reduces this problem. And I believe that utilities are one of the best performing sectors as yields have gone down, and in India they have not done as well as they have done in other parts of the world. So I think clearly there are many opportunities. The corporate NPL cycle is clearly, I would say, more or less done outside a few sectors, and that's why I think there are interesting opportunities here. And we prefer companies which are present in both corporate and retail rather than companies which are just present in retail, because retail has had a long cycle which has been good, whereas corporate has had a long cycle which has been bad. So we like this combination which are present in both corporate and retail to companies which are just present in only retail.
Yeah. Naren, thanks so much for joining us today and wishing you a very happy Diwali.
Same to you, all of you.